Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax. To our viewers at home, we have a very big show today. You're not going to want to miss one moment of this show. We're going to discuss the recent bank failures, how to know that you're truly diversified, very important, and how to plan a tax-efficient retirement. Stewart, first of all, how are you today?
Oh, I'm doing awesome. We're in a new studio here. Well, they're doing some work on our main studio. I'll see if I can adapt to the new place here.
Knowing you, you adapt well in any situation. So I'm so excited about today's show. First off, I'm going to ask you right out of the gate, Stewart, what is happening in the markets right now?
Well, we obviously are seeing pretty crazy volatility. Obviously Jerome Powell has had a tough time getting inflation under control. And I think that we're in a new normal now with all of this movement of the market back and forth. And I think that historically, people have been so accustomed to this amazing stock market because for years, it did incredibly well. And what I want to do first is pull up the S&P 500 historical slide. And what this will do is really put the stock market into context. And this, covers through the end of last year. But you can see that just amazing run that the market's had for 12 years or so. Obviously last year was terrible. And I think, Cynthia, if we're thinking about the markets and thinking about what people should do, a lot of our clients are conservative. Some of them are really aggressive. And if you were an aggressive investor and had 100% of your money in equities, well, you know what? You got hit by the market, right? We're down, right around 20%. But what's really surprising to us, Cynthia, is that the conservative investors got hit hard as well. And I have a slide that I think will really illustrate the point. And this slide here is showing 2022's S&P 500. That's in yellow there, with that silver or white is overlaying the iShares TLT ETF. And what that is that's an ETF that looks at the 20-year treasury. So if the S&P 500 is down around 20% and the TLT, the 20-year treasury ETF, is down 30+%, the conservative guy got hit harder, right? Wow. So when normally the move is just to say, hey, let's go to bonds, we'll be safe. That didn't work last year either. So the one thing that I'll say is better news is we had one of the greatest beginnings of the year for the stock market since 2019. The S&P 500 in January was up 6.3%. February was down, so it seems like that that run ended. March kind of mixed. We ended up flat, so to speak, overall for the quarter. But we're seeing just incredible amounts of volatility.
Absolutely. And I know, Stuart, you're very passionate talking about short-term rates. They look great right now. But I have to ask you, where do people find these short-term rates? Well,
the easy answer is the banks, right? And these short-term rates are neat. I have tons of clients that have come in and said, hey, I'm going to go buy this CD for 4% or 4.5% or 5%. And, in their minds, that's the safe money. And historically, it has been. In right now, we're seeing this kind of distorted market with this inverted yield curve, and short-term rates are actually paying better than long-term rates in this kind of funky market that we're in right now. And I have a graphic. I want to show you the historical inversions of the yield curve. And what this is showing in red at the top of this graphic there, it's showing in red when short-term rates are actually paying more than long-term. And it basically looks at the spread between the 10-year and the 3-month treasury. So right now we're in this inverted curve where short-term rates are better. And what's the answer? Historically, it's to go to the banks, right?
Right. But I have to stop you right there because obviously the banks have been in the news so often recently. So my question is, how are people feeling comfortable right now putting money into the bank? What are you hearing?
Well, it really is the safest place historically for your money if you make your deposits because of the FDIC insurance. And, people have been able to rely on that for a long time pretty comfortably, but the one thing I just say, Cynthia, is that, we've always said, hey, this is a $250,000 maximum insurance threshold, and we've been able to rely on that. The FDIC, they have the money to pay it back. They usually handle it through acquisitions and so forth. But what's really alarming now is that for our clients in Arizona, in Nevada, in Denver, I don't know if that really applies to them, because you start looking back, obviously, at Silicon Valley Bank and Signature Bank with their recent failures, and now we're seeing this complete change of direction. Janet Yellen originally said that we're not going to go ahead and bail out these people that have excess money over and above those thresholds. Well, of course, that's what they're supposed to do. They're supposed to say, hey, we're only going to guarantee up to 250. But if the banks in Silicon Valley or New York with Signature and they're donors to a certain party, well, all of a sudden now it's unlimited bailout. Are they going to do the same thing for our small banks in Arizona and Nevada? I don't know. It's just become this really political thing. And, it's scary.
It is scary. It's causing a lot of anxiety, Stewart. So if people are definitely nervous about the market right now and they're scared of banks, in your opinion, Stewart, what exactly should they do?
Yeah, I think people just need to get advice. They need to make sure they're talking to a professional that, can really show them how to make sure that they're properly diversified. And I think having all your eggs in one basket, whether it's at a bank or an insurance company or the stock market, I think is a big mistake. And if you guys have concerns that, your bank may not be up to par, we have some resources to kind of look at some of those things, but you don't want to take advantage. And here's the one thing I'd say, is that if you go to the local bank, you can talk to the branch manager and they'll say, hey, well, if you put 4 beneficiaries on, then you have, 4 times the FDIC insurance, that'll insure $1 million. And I would just say this, cool your jets. If you have more than the 250 in the banks, you need to think about spreading it between multiple banks. Why would you take that risk? You're going to wait for them to lock down your money and wait until the FDIC releases it? I mean, how long is that going to take? Right?
Exactly.
So I would just say this. If you have concerns about where your money's placed, if you think you're taking too much risk, what we're offering is a complimentary portfolio review. And what we're going to do for the first 10 callers, we're absolutely swamped here, wrapping up tax season. But for the first 10 callers, or the first 10 people to click on that QR code in the bottom right of your screen, what we'll do is we'll take a look at what kind of fees are you paying on your current portfolio? What kind of risk are you taking? And are you properly diversified? But you have to take action and give us a call at 833-652-7829. Even easier, click on that QR code. It'll take you to our website, apsitaxes.com. We'd be glad to help, but you have to take action.
Stewart, thank you so much. To our viewers at home, that number to call is on your screen, 833-652-7829. We are going to take a very short commercial break, but don't go anywhere. When we come back, we're going to talk to Stewart about how you would know, can your portfolio handle a volatile market, and are you diversified? What should you be looking for? Stay tuned. We'll be right back after this very short commercial break.
People are really concerned about outliving their money. Inflation, taxes, volatility in the markets, legacy. That's what people are really concerned about. Listen, I love what I do. When a client of mine can know with total confidence that they're going to be okay. At Asset Preservation, that's exactly what we do. Not only do we look at your investments, we look at your taxes and estate planning as well. We don't leave any stone unturned. That is what a real holistic shop does. Provide a very clear roadmap so that you know it's okay to enjoy retirement. Success is being able to sleep at night. And at the end of the day, what we provide at Asset Preservation is not only the market expertise by institutional money managers that are some of the biggest and best in the world, but we also provide complete advice. You need to make sure you have a plan. What you can expect from us is to let you know the truth about your portfolio.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis, President of Asset Preservation, Wealth and Tax. Stewart, a great show we're having today, talking about such important topics, of course, all surrounding current events and what's happening in the markets. Everybody hears the word diversification. My question to you, Stewart, is how does someone know that they're truly diversified?
Well, I think that's probably the most misunderstood thing in finance. We have clients that come in all the time. They'll have 50, 60, 100 different positions in their portfolio. And Cynthia, they really think like they're diversified because they have so many investments. And oftentimes what we're finding is that, they all do the same things. If you have 3 different funds that react identically to the stock market movement, they're all to us the same thing. They're very highly correlated. But when we talk about diversification, when I talk about that investment diversification, that is just one aspect. That's your diversification of investments. What I think you also need to look at is your diversification of tax classes. And what we mean by that is that a lot of you have done your job. You've put away all this money away, tax deferred, and you put it into your 401ks, your thrift savings plan, your deferred comp, 403b, whatever. And you put it away because you wanted to save tax. The problem is when you start taking that tax out, it's going to be a problem. You could be building up this tax time bomb. So to us, you need to make sure you're not just looking at those IRAs and thrift savings plans and 401ks, but you're also considering the Roth aspect of it too. So you need that tax class diversification so that you can pull assets from multiple different strategies. The next thing I'd talk about diversification is the diversification of perspectives. And let me explain it this way. If you're dealing with a financial advisor, maybe way smarter than me, very, very likely, right? But
I don't know about
who
that.
knows? I don't know. I don't know if my wife thinks I'm very bright, but my kids definitely don't. But but I'm sure your advisor's a really smart person. But let me ask you this question. If you're watching them and pick the fund, say, hey, I really like this growth fund or this stock or this, what if they're wrong? Are you going to bet your whole life savings on them being right? Your whole life's work, the decades of work it took to put this money away?
Great point.
What if they're wrong?
Yeah, absolutely.
Right? It's like putting all your chips on black when you go to a roulette table, right?
Absolutely.
It's a big, big risk. So for us, what's really important is a diversification of perspectives as well. And what we mean by that, at Asset Preservation, Wealth, and Tax, what we do differently than most is that we have multiple points of view being reflected. Look, if you watch the conservative news channel, you see the world one way. If you're on the liberal, cable news channel, you're seeing it completely. You're on 2 different planets.
That's true.
Right? 2 different smart people
Absolutely.
can see the world drastically differently.
100%.
Right?
Absolutely.
And it's like when someone sees Trump getting arrested or Trump going to court, half of America is like, oh, he deserves it, he should go to jail. The other half is like, no, we're gonna rush the Capitol or whatever,
so
right?
Right. It's true.
And the point is that 2 different rational people can just drastically see the world differently. That's got to affect your money managers. That's got to affect them. And so what we do is we have multiple money managers. It's not me picking your funds for you if you're a client. It's me picking the money management team so that if one guy gets it wrong, it doesn't pull down the whole portfolio, that your whole life's work doesn't go down the tube. Because look, last year was a complete disaster in the market, and not all of them got it right. One of our money managers got it wrong. But it didn't bring down the whole kit and caboodle. I have clients all the time that come in and they're financial advisors, the guy picking the funds, and they're charging the fees. And a lot of people will ask me, well, why doesn't everybody else do this? Why don't they have private money managers, outside counsel, all that stuff?
Great question.
Well, because it comes out of their pocket. They have to pay for it. And I would say this. Look, I could hire a great money manager to work for me down the hall and, pay him 150 grand, 200 grand. It's a great living. But if he's wrong, I'm going to put my whole client's portfolio on it. And look, just pretend I'm not concerned about you, the client. Let's pretend I'm just concerned about my business, right? Remember, the amount of money we manage determines how much I get in fees, right? It's like that saying, when you do better, I do better, right?
Absolutely.
And at the end of the day, as a business owner, what I want to do is make sure that my clients are diversified so that if one of them gets it wrong, yes, of course, the clients are protected, but it's also protecting the business. And so rather than overlooking or being concerned with this short-term expense that it costs me, not the clients per se, I just think it's worth it. I want some of the biggest money managers in the world watching. I want some of the best. We hunt down the best. They all see the world differently. And I think it's a really important thing to have that diversification. The other thing that I think is important is to understand a diversification, not just of perspectives, but of strategies. And what I mean by that is a lot of people are buyers and holders. Other people are quick traders. They're strategic or they're tactical. And let me explain what I mean by that for a second. So if you look at a tactical plan, for example, I have a slide that I want to pull up for you.
Okay.
And this is one of our algorithm money managers that's very tactical. And basically what they've done is they've identified 6 distinct stages in the economic cycle. And so look, if we're in stage 1 there and we're starting to go into recession there, well, guess what? There are different investments that perform better in that environment than when we're in this stage 3 where the market's taking off, right?
Absolutely, yeah.
And that's the point, is that there are different investments that perform better in different stages. So, Cynthia, I think it's important to make sure that you consider multiple strategies, multiple perspectives, and multiple tax classes, and then you can be truly diversified. And I think most people just lack that.
Well, Stewart, I can't even imagine if someone is one of those do-it-yourselfers that's trying to figure all of this out at home. So I have to ask you, if the audience is concerned right now to know if they are truly diversified or not, what should they do?
Well, number one, you should seek help. I've said it before and I'll say it again. And so, I don't just like to present problems, I like to offer solutions as well. And what we're going to do is, for the first 10 callers, we're going to offer that complimentary portfolio review. And part of that is looking at how diversified you really are. And we look at 2 different risk analysis groups. So, of course, a lot of people rely on, an amazing company like Morningstar, but we also have another technology that analyzes it from a different perspective, because sometimes they don't see, the same thing in the same way. So we will take a look at whether you're diversified truly. What kind of tax issues do you have? Are there tax concerns? And tax is really important to us. We're just, wrapping up tax season here. And what kind of fees are you paying? And if you don't know what kind of fees you're paying, then you need to find out. And we'll take a look at all of that with our deep dive view in our complimentary written retirement plan. But you have to take action. Give us a call at 833-652-7829, or even easier, click on that QR code. It'll take you to our website at apsitaxes.com. You have to take action. We'd be glad to help.
Stewart, thank you so much. To our viewers at home, that number is on your screen, 833-652-7829. We're going to take a very short commercial break, but don't go anywhere. When we come back, we're going to talk a little bit more about the Roth and whether tax planning makes sense for you. Stay tuned. We'll be right back after this very short commercial break.
Right now, the market is a big mess, and oftentimes people feel lost. So while most people are scared, you need to know that you're going to be okay. I'm sure you have a lot of concerns about whether your portfolio really fits you. And if you need help, all you have to do is give us a call. At Asset Preservation, what we offer is a complimentary portfolio review. We can provide that fresh set of eyes to give you that second opinion. You can't get a second opinion from the guy who gave you the first. You want to make sure you're dealing with a fiduciary. We'll give you that fiduciary perspective. If you have a relationship with a financial advisor that you don't entirely enjoy, I think that's a problem, because these relationships are not meant to be short term. They're meant to last a lifetime. You don't want to deal with people you don't like. If you have concerns about your portfolio, you need to give us a call.
Welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis. He is president of Asset Preservation, Wealth and Tax. Stewart, you talk a lot about taxes, even when we're not on air together. When I see you, I'm always talking to you, and it's always around taxes, it seems like. So I have to ask you, do you see this as an important issue for your clients overall?
Yeah, I think it's the most important issue, or at least as important as the investments itself, because everybody knows the old adage. It's not about what you make, it's about what you keep. And I also say it feels like for the first decade of my career, I feel like I was faking it. And I say that, yes, I tried my best, and I think most advisors do. But until I owned a tax office and I saw the real implications of the decisions people were making from a tax perspective, I never really understood the impact. And you only understand that by seeing hundreds or thousands of tax returns over time. And you just have to remember, when you go and file your taxes, or if you do them yourself, you know, most people are just trying to save the most they can right now, right? They're trying to get as many deductions, offset taxes, so they don't have to pay it now, they can pay it later.
Yeah.
But I think that sometimes is a big mistake because, you know, we're in one of the most efficient tax windows in history right now. And I have a slide, it'll demonstrate, I've showed it before, I'll pull it up again. And if you take a look at this tax slide here, we are in red right now.
Okay.
And blue is where it used to be in 2017, before the Tax Cut and Jobs Act. Some people call it the Trump tax cuts.
Okay.
But, you know, the way I look at taxes is when you go from the 10% to 12% bracket, that's a small jump. But going from 12 to 22, as you can see, is a huge jump, right?
Absolutely.
22 to 24 is a small jump, and then
Yeah.
24 to 32 is a big jump. It's a huge jump. But the thing to look at when you're looking at this graphic, Cynthia, is to understand that we're reverting back to those old thresholds at the end of 2025, beginning of 2026, if Congress doesn't act. And so just understand, let me pull it up one more time just for a brief moment here. If we're reverting back to those blue era tax rates,
Yeah.
it's about having a plan now while taxes are low. Look, are they changing for sure, Cynthia? I have no idea, right? Like at the end of the day, when Donald Trump was able to sign it into law, the tax cuts, he did it during one of the greatest economies the world's ever seen. That was before Congress and Senate and our presidents, and it's not just Biden, it's Donald Trump as well. They spent so much money on stimulus, you know, for COVID. You know, we're $9 trillion additional debt here.
Right.
Someone's got to pay
Right.
that back, right? And so getting a tax cut, you know, in this environment, to me seems unlikely. Who knows what's going to happen? But what we know for certain is that if Congress doesn't act, taxes are going back. They're sunsetting, not only income taxes, but estate taxes as well. So for us, I think the concept is to say, hey, does it really make sense to defer taxes till later when quite possibly taxes are going to go way up, right? And what people don't think about in retirement is that when you put away all this money tax deferred, it's not just the tax that you have to pay on those investments. It's the way that those income streams, those taxable income streams in the future will start making your Social Security more taxable. And for a lot of people, they've done their job. They've come in, they put away $500,000, $1 million, $2 million, $3 million in their IRAs and 401ks. And they want to plan that, which is smart. But they never consider Social Security, which for a lot of people, as a couple, could be between $1 million and $2.5 million in benefit over their lifetime.
Yeah.
Why aren't they planning the taxation there? I think
Yeah.
it's really important to have a plan.
Stuart, I couldn't agree more. And obviously in our last segment, you talked about diversification. You talked about the Roth a little bit. Can we talk more about that? What exactly is a Roth and how does someone know if it's right for them?
Yeah, so the Roth, you know, compared to its counterpart, the IRA or the 401k or the thrift savings plan, with those plans, you get a tax deduction. So let's just say that, you know, you're putting money into your employer plan and you're putting away 10%, but you're deferring the tax until later. And the concept is that your taxes are going to be lower in retirement than they are today. Maybe that's true, maybe that's not. I have some doubts about that.
Yeah.
But when you're meeting with your tax person as well, they'll say, hey, if you put away $5,000 into your IRA, you could save $1,000 right now on your tax. And it sounds like a good idea. But at our tax office, I have to untrain and retrain our CPAs and enrolled agents because they're oftentimes creating these tax time bombs. Because with a Roth, you don't get any such deduction. But guess what? All of the future growth is tax-free, the principal's tax-free, and it doesn't, you know, make your Social Security more taxable under current law. Not just that, when you pass away, your heirs will receive it tax-free. So I think it's important to really think whether or not it's good for you.
Sure. Stewart, I've been hearing a lot about the Secure Act 2.0 and actually the actual Secure Act. Can you talk a little bit about how these are relevant?
Yeah, they're super relevant to tax planning and the Roth itself. And the reason is, now, I've said the story before, but in November of 2019, I went back to Washington, D.C. We met with the staff of Kirsten Sinema and McSally at the time. Also met personally with Debbie Lesko and Dave Schweikert, as well as the staff of Andy Biggs. And we were pushing for this Secure Act because what we wanted to do was just make sure that, that required minimum distributions were delayed. And we got that done. It went from 70.5 to 72. And the problem is that there were some inadvertent, additional things. When they talk about the pork that's written into these bills, additional things.
Yeah.
Well, what Democrats wanted to do is they basically wanted to compress the amount of time beneficiaries had to pay it out, because historically, when you pass away, you could pass your assets to your kids, your IRAs, 401ks, and they could take it out over their lifetime. Well, Secure Act actually compressed it to 10 years. Democrats wanted it down to 5 years for accounts that exceeded a couple $100,000. They were able to make it universally 10 years for everybody. But now your kids can't take it over their lifetime. They have to take it within 10 years. So now they're getting taxed at a higher potential rate. And the stretch IRA at this point is dead.
Wow.
Yeah. And so the Secure Act 2.0 just, signed into law this year. In the Secure Act 2.0, extended RMDs until you're age 75, and it's gradually up to 75. It's 73 right now, but it works its way up there. And is that a good thing, a bad thing? The concern I have is that for people that are deferring their Social Security or their RMDs, they're creating these irrevocable income streams that are going to all cascade when taxes go higher.
Yeah.
So if you have concerns that you don't know what to do, should I take my RMDs early? Should I do a Roth conversion? Just reach out. Give us a call at 833-652-7829. We only have room for the first 10 callers this week. Click on that QR code. Feel free. We will look at whether a Roth makes sense for you or not. Are you taking too much risk in this market? And are you putting too much money into the banks alone that may also put you at risk? Everybody's situation's different. Stop listening to your friends at the water cooler and get real advice from a real fiduciary. But you have to take action. We'd be glad to help.
Stewart, thank you so much. To our viewers at home, most specifically, we'd like to thank you for spending time with us today. That number to call once again is 833-652-7829. We know you have a lot of questions for Stewart about everything that's happening in the world right now. He has the answers for you. Be safe and be happy and be blessed. We'll see you back 1 week from today on the Asset Preservation Hour with Stewart Willis.